time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
All right, but Voxtur Analytics, symbol VXTR on the TSX Venture, is a real estate technology company. The company offers targeted data and analytics to simplify tax solutions, property valuation, and settlement services through the lending lifecycle for investors, lenders, government agencies, and services. The stock is down a whopping 78% year to date, and its current price is about 26 cents. The company recently had its Q3 earnings just last week, and management was highlighting these great revenue growths, 44% year over year, 42% gross profit increase year over year. But the story is different when you look at the quarter over quarter. Revenue dropped 7% in the last quarter compared to Q2, and gross profit increased slightly at 7%, but it's still down year to date. Well, compared to the first quarter, I should say. Management is forecasting revenue to be in the 140 to 150 million range, which does not include its recent large acquisition of Blue Water. But this does mean organic revenue. So organic revenue is revenue without the acquisition would be between 25.5 million and 35.5 million, which would mean revenue is expected to drop again quarter over quarter. And at this point, it would actually be year over year drop. So you're looking at a weaker housing market, which of course is a massive factor in this industry and for this company. But when you're posting these highlights of we're increasing, makes me quite skeptical when you're posting only increases when in reality they're slowing down. But then we'll look at net income, which has been editing Brett here. I misspoke in our initial recording. I stated that net income was decreasing quarter over quarter, but it's actually improved on a quarter over quarter basis as well as a year over year basis. Or is slightly better since Q4 2021. And it is just all over the place with EBITDA. And I don't know what to take of this. There's no real trend to it. So it's something which I'm looking at it and wondering, are they actually improving here? Are they going to create a positive environment in the future when there is a positive macro environment? Right now, there isn't, and they're up, down, up, down. So, but what I'm really watching right now for the company is their balance sheet. They've been taking on massive loans for their Blue Water acquisition, amongst other acquisitions in the past. This is through a line of credit, which they actually broke the covenants of for Q3. BMO has since waived that, so pretty much they're saying, hey, we believe you guys enough that you're not going to go bankrupt in the next year. So initially, on their actual Q3 earnings, they had it in their current debt, which means they have to repay it in the next 12 months. But now, since as of the earning calls, which was just a few days ago, they're going, hey, you can go back to before, so it's non-current, so it's about 3 to 5 years for most of these loans. But that's not to say they're in the clear. If they break these covenants over and over again, BMO might raise the interest rates. They might just say, you owe us all the money in the next 12 months, which is what their initial covenant breaking, if BMO did not waive it, would have occurred. So that's just terrifying as an investor, because if they called that, they would have most likely been in bankruptcy at that point. In addition to the debt issuance, the company has issued significant shares as well to help fund its various acquisitions. For example, the Blue Water acquisitions, their large acquisition just a few months ago, added 124 million shares. So that's about a fifth of their total shares issued. And these shares aren't all out, so you're not going to see on their basic EPS. They're all vesting over the next 16 quarters. So you're going to see continuous dilution of basic share in the next 4 years or so. There is a bit of positive news, though, in the last quarter. The company has just squeaked over the zero line. They've become positive for operating cash flow of 49,000. That's effectively zero. They're flat. But it's an improvement over the previous ones where they're 7 million for Q2, 6 million for Q1. And additionally, Blue Water is an accretive acquisition, so their cash flows will be ever so slightly higher, most likely, in the coming quarters. But that being said, the company does not expect free cash flow, which is this operating cash flow minus the investments. So whenever they're doing an acquisition, you would take that off operating cash flow, and there's your free cash flow. There's a few other things that go into it, but that's the rough understanding of it. And they're not going to be free cash flow positive until 2024. So you're looking at still another year of them burning through cash. So Arte, the company is just too risky to be investable. The company's capital structure carries significant risk due to the debt levels and the impending dilution. Revenue growth is stalled out in the harder real estate market. There is the glimmer of hope with a slightly positive cash flow, but I'm not really going to trust it. I'm not taking it. I've seen some comments online saying they're positive. It's $49,000. It's nothing. It's something which in maybe 2-3 quarters from now, if they're $1 million or $2 million positive, I'd enjoy that. I'd like that. But for now, it's nothing. Maybe in a year or two, after the real estate market has bottomed and we actually have a better idea of where it's going, you could maybe consider it. But for now, I'm staying away.
Yeah. So
I'll open it up to you guys.
So after those shares vest, like the company should have is it about 700 million shares outstanding? Is that correct?
I think it's about 650 or so.
650? Okay.
And what's the market cap on it right now again?
I don't have that up.
About
100 something.
100, yeah.
Yeah, and that's 60 million in debt.
120, 119. Yeah.
Yeah, 60 million in debt. So it is quite.
That's a lot of debt for a company their size. No profitability, no cap. I don't even understand they get a loan when they're not generating.
The 30 million US was related, so 40 million Canadian was related to their Blue Water acquisition. So it's really pending off that, and
they incurred debt from the acquired company, right?
Yeah.
Yeah, I mean that's and this is an example of a company. I mean, they can really run into trouble when that debt comes due, because how do you pay it? I mean, there's either you pay it from internally generated cash flow, or from getting more debt, or from issuing shares, and there is no internally generated cash flow, or virtually none. Banks are going to really be reluctant to loan them any money. And in addition to that, it's issuing shares to pay it off. They're going to have to further dilute. So it's a tough. If the market were hotter and there's a lot of excitement around that space, which there has been in the past, data analytics, then maybe you find somebody who's willing to back it. But at best, they could do is essentially go to their creditors and say, "Listen, we're not going to be able to pay it back. You have to extend terms," which they may be able to do. But, it's not going to give you a good reputation amongst creditors.
No. As at September 30th of this year, they have like a $40 million working capital deficit.
Okay, so you need to add that on. They need to come up with $40 million.
Yeah.
Just over the next year.
Current portion.
I should add that's because they had those covenant debt breaches. So in the next quarter, you're going to have the 60 million if it go back to non-current. So they are actually... Because BMO was so nice and they let them essentially say, "Hey, you broke the covenant," but
it's not that BMO's nice; it's that BMO knows they're not getting money regardless. So they may as well extend it. And
I'm sure they've been told as soon as we bring this acquisition in the fold, we'll be generating a ton of cash flow. But I mean, but
eventually the creditors find to get 5 cents on the dollar if that's all they're going to get, right? Yeah. So, and that's basically sell off your assets.
I mean this company used to be called iLookabout, and we looked at it for a number of years. The capital structure here, since they got really aggressive on the acquisition front, they're just not paying attention to the capital structure. Like if they end up with 650 million shares out, a working capital deficit, I mean, it may shift if that the near-term debt goes to long-term debt. But it's a lot of debt for a company of this size in servicing a sector that is facing some people are saying historical slowdowns near term here. So you couple all those things together with again with that horrible capital structure. There's likely going to have to be a consolidation here. That's there's too many shares. You can just see that. And an equity raise at some point if they can come out on the other side of this. But I mean, they should be in cash conservation mode right now, and that's not a growth mode. And like Brett was saying, organically, it's not growing. From what we can tell, it's just the acquisition growth here. Bring that in, and I mean, you're going to have to see some cost cutting just to keep the business going. Likely, I mean, at this point. So we'll see. We'll continue to monitor it, but. It's not good to have debt covenants being broken, share structure out of control. And even if there's tons of revenue growth, I mean, we've seen companies implode before. I'm not saying that's going to happen to this business at all, but we've seen companies implode before with very strong revenue growth. But you gotta have actual cash flow, not 49,000 cash flow. That's not cash flow.
Yeah,
but
and
you gotta bring that in because there's a lot of debt here, and there's 12 million or something in the bank, but you need more than that if you're going into a prolonged slump in the real estate sector. So,
like Brett said, even if they could produce, potentially $1 million in cash flow or something like that, like based on the capital structure and how much shares they have outstanding, that would only be 0.0017 cents in cash flow per share, which is
start producing 10 million in cash flow, and even
then
it's
hard to create meaningful per share cash flow or earnings when you have that.
That's why you got to mind the capital structure, and that just hasn't been done here. And that's why we would say, if I had to make a prediction, if something else doesn't happen first, there would be a share consolidation and go through that whole song and dance.